All right, so let's just take a look at the opportunities that were in the market today. We'll start off with the ES. There was an ES and there was another in crude, but it was too difficult to catch. So in the ES, and also this is really important because I think there's a break here, but anyway, we'll get into that later. So you had the market rally, pull back right here. So it sprung right there. How do you know? It took out the low and did not have follow through. So it's a very basic type of spring within trend within a rally. All right. So spring within trend and a rally. So you have a trend. There's a rally in a trend. There's a spring within a rally. This is the rally. Tap tap spring boom. All right. So it's just so when it was hitting the spring, you had this buying come in. Let me take away the break even. Why do I break? All right. So you had the buying come in. So again, the trend, you just have to understand this. Trend is like one of those things that you have trends within trends within trends. All right. What does this mean? It means you have one dominant trend and it has a lower time frame trend in it, which comes in the form of a pullback, and they actually offer pullback opportunities. So you have the rally, and then you have this pullback here. You have all this shit. This is all part of the pullback. And then you have the initial trend reasserting itself right here. All right. So that happened. And the thing I want to mention is you just have to understand that when you get this, when you get the change of behavior, buying, sign of strength, sign of weakness, a change of behavior wave has a change of behavior bar. Typically. So even when you have a sign of strength wave, it has a sign of strength bar in it. Sign of weakness wave has a sign of weakness bar in it. All these buying and selling waves that are really strong, they should have the bars that are really big and strong bars, because it shows that there's aggressive buying or selling that's taking out the overhead supply. So here, for example, the buying came in, and over here you had the biggest green bar in 68 bars, and over here you had the biggest green bar in 69 bars, and the biggest consecutive bar in 100 bars. Now, that's really, like, to me, that's like a threshold. When it hits that number, it's really very obvious. I mean, this is just very, very obvious that this is aggressive buying. Then you just watch the pullbacks and, you get the tap, and look what happened. Up and away. Now, this is where it's going to get really, there's an issue with if you're bullish. Right here, as it went up there, just one move, one leg, right? Just one big move, got overbought. Tap, tap, break. So this is a problem. And in the higher time frame, this is a break of structure. In the hourly time frame, it's a break of structure, or whatever the hell they call it, a trend break. This is just a common language. It's called break of structure, but it's just a trend break. How do I know? This breakout, right, is like taken out, meaning it's low before the breakout. The origin of the rally was broken, and it was broken not with with like a spring or lightly, gently, like a shakeout type. This is a pretty big bar, and it's taken out the origin of the rally. So I can't be bullish, because when you see the breakouts failing, it's basically two ways. One is in the form of a spring or an upthrust, where you have breakouts and breakdowns failing because they don't have follow through. The other failure is when the low before the breakout, which is the origin of the rally, when it is taken out definitively with a big bar, meaning it's basically this right here. It's another way of, so this is really bad. So I think that this has topping action, and this was then part of a wave which has the biggest in 10 waves. So there's follow through after that big bar, which took out the low before the high and basically invalidated the green breakout and took out the rally low. So this is not what you like to see. So I want to see how the bulls respond as you get closer to the initial support here. But as of now, I can't be bullish with this break. And I want to see if this is going to turn the daily. It should turn the daily. Like here, it should turn it to go down. So, yeah, just wait. All right, so we'll see how this thing reacts. But I'm definitely not bullish at this point. In fact, I'll be looking for both bullish as well as bearish trades. It's only bullish if it reasserts itself and rallies back up. Otherwise, it's going to rally back down, and rather look for sell trades. It's because the trend is broken. That's how it breaks, right? This breakout was very vicious. It was the biggest in 35 bars and had fall through, rallied, and this is the spring low that caused it, and it's broken. So done. All right, now we're going to take a look at crude. Where the hell's crude? All right, so crude had a trade, but it just didn't. See here, you see here after it has a breakout, it was the biggest breakout in 53 bars. This low was taken out. As it was taken out, the buyers stepped back in and reasserted themselves. This is what needs to happen in the ES. Okay, so it's a very, I guess it's coincidental, but this is exactly what needs to happen. Otherwise, the daily is going to turn. All right, so over here, what you had was the market was pulling back, and it attempted to break. It attempted to break right here, below this spring. It attempted to break, and look what happened. So I'm watching this thing, and I see right here. Now, as I'm explaining again and again, you know, when you have this aggressive buying, the aggressive buying is not in just terms of a wave, it's terms of bars. So here you have the biggest bar in over 100 bars. What's that telling you? It's telling you the buyers are not going to let the market break down. So what do you have? Right? So it just goes up. So this is aggressive buying. Basically the market went down, up, down, and right here, see this low? See this low? That's right there. All right? They started buying. Someone flushed it or attempted a breakdown, and it was immediately bought back up. That's a spring. That's a spring. Meaning the attempt to break down has no follow through and is immediately bought with aggression. So that's how you see the spring. And one other way to see it, you know, right here is when you have a breakdown, right? Look at the bar that comes up back into the range. That bar is the biggest bar in 100 bars. Okay, so if you take this, right? Attempt to break, reversal. Reversal is actually a reverse breakout bar, but I mean, it means that instead of getting the breakout bar here, you get it in the opposite direction. And here you see the biggest reversal, and that bar is the biggest bar in 100 bars, going back within this range, right? Now compare this to the ES. Do you have this type of action right now occurring on the ES? Let's go to it so we can compare and contrast, right? To see if they're going to defend it, if the bulls are going to defend it or if it's going to turn. Now, remember this picture of crude and how aggressively it came from the spring? All right, now we're going to see the ES. So you have this low, breakout, breakdown, aggressive. Look at the response so far. Look at the response to this breakdown. You have the biggest wave in only 2 waves. You see, actually this buying was there, so we have to be careful right here. There was buying. This is pretty big green buying in whatever number of waves, so it can reverse because someone came in here, right? Someone sold and someone bought. I'm not sure if it's covering or not, but those bars are telling. So that's why I'm a little unclear. What I do know is that if this was, you see, you can have a big green bar, and that can be your sign of strength bar and all that, but it must have follow through, and I don't like this follow through, right? Otherwise, what the bar, a lot of times it can just be like heavy short covering on the break, meaning they're using the break to take profit. So that's why this wave is only bigger than the last 2 waves. Whereas in the other case, it was, I don't know, bigger than a lot of waves, right? And this low gets taken out. So I'm seeing if these guys that bought or covered are going to step back in or not. You know, if there's going to be a weak move back up, it can set up the short to the downside. In general, I don't like it because this bar here is very strong. It breaks the low, has follow through with the biggest wave in 10 waves. Here, this is the biggest wave in 24 waves. It has a strong bar, has poor follow through, biggest in only 2 waves, and continues and takes out the low. And now we'll see how strong the counter trend back up is. So, I mean, this is the counter trend is starting, and we'll see how strong it is back up. All right. Besides that, let's take a look at some other markets. I really don't know which market I want. Probably maybe I'll take a look at gold. All right, let's go take a look at gold. What happened here? Yeah, I don't know. This is also broken. It's clearly broken. It's broken. All right. Also notice where these lines are. These white lines represent where to start looking at trades and where to have the stop, right? So this is those have been broken. So this trend is in play, right? From this high, this trend is in play. As you can see, it's going down. Now, I'm not a fan of trend lines and all, but sometimes they just help you visualize, and you have good move, right? So anyway, so this is what gold's doing. Am I that much of a fan? No. Why? Because the trend here looks still strong on the daily. So I don't know. There's too much support here. There's one support here. There's one support here. So it can easily reverse back up. And I don't want to deal with that. All right. So what else we got? I think that's enough. All right. So now I'm going to go on to the a lesson. All right. So one of the things that you'll see is I've showed a lot of like technical skills and all that, but you have to understand that in trading there's a lot of psychological skill, and I don't think this is really understood at all. It's not just, FOMO, fear, and all that, but like seeing the practical applications of it. All right, so I'll give an example. Market is going up. This is your higher time frame. This is your rally. This is your breakout, right? So you say to yourself, this thing is, let's give it more of a breakout. So, you basically are buying pullbacks. So what I want to clearly mention, let's just say at this area right here. All right, so if you're buying pullbacks, you're not interested in this at all. You're not interested in this within this area. Meaning above that green line, you're not interested. Here, you're interested. Okay, because you're buying a pullback to, support or whatever. Right? So here, as the market, let's just say this is some multi-hour market, right? Here, right here, there is no point in watching the market. Don't care. Don't care. The attitude that should be taken is, this is not of interest to me. All right? Don't care because I don't trade this, because they're traps, inducement traps. All right? So here, then the other thing, don't care, and I don't watch. Oh shit. Don't care, don't watch. This is really, really important. All right, because what did I do? Don't care, don't watch. All right, now what happens here is really, really important, because as this thing is pulling back, don't care, don't watch, don't trade. Why? All of the, if you're looking at the market here, it's going to cause errors. All right, in this area, in this upper rectangle, you will be, this is the results. All right. All right, and I want to point this out because no one talks about it. But what is the result of watching the market before it comes to your level or area of interest? Area of interest to find trades, right? So what is the result of that? One, it's going to lead to losses. Why? Early entries, both long and short entries that will get stopped out. This will happen. If the market is pulling back and you're looking at it before it comes to your levels of interest where smart money is going to buy, smart money is not going to buy up here. They're going to wait for it to pull back and get in. Why? Because they're not stupid. All right. So this here will have, number one, if you watch it, you will basically get in. You'll get early entries, you'll have losses, both long, short entries, you're going to have that. You're going to have revenge trading, which may lead to overtrading the size. It will be exhaustive. So the point that I'm trying to make is that looking at the market is not the smart thing to do when it's in areas that you know you have no edge. You want it to come back to a support level, however it is that you define support. Some folks use levels, some will use VWAP, some will use zones. Before it gets to the area that you know how to trade, right? It will take a lot of time to get to those lows. All right? This is very important. The market knows you are not patient. Okay? Market's not dumb. Those guys, they're very smart. Whoever's, manipulating it. The market knows you are not disciplined. Are, what is it, FOMO and greedy. Okay? The market knows you're not patient. The market knows you are not disciplined, meaning instead of getting like a reversal bar, you might just buy it because it looks like it's going up. So whatever your rules are. Okay? And it knows that you're FOMO driven and greedy. So, and you know what? Here's the thing. If you look at the market, even if you are patient and disciplined and not FOMO driven, you can make mistakes by watching the market for long periods of time. Okay? That's the point. Meaning the first hour, the second hour, the third hour, the fourth hour. Okay, we're at lunch, after lunch, the fifth hour, the sixth hour, after that. If you are watching the market for long periods of time, it will break you down. That's the bottom line. I mean, maybe your experience is different, but that's the case. The more you watch the market, the more you will be induced to make errors. Okay? Very important. Very, very important. The more you watch the market action here for hour, 2 hour, 3 hour, the more likely it is you're going to get hurt. You're going to make an error and all of that. So if you look at professional traders, what do? They mark right? So here's the point. Levels, and there is no point. Okay, let me say it another way. All right, first levels, should I say first levels, second is behavior. Okay, first is levels, second is behavior, not the other way around. If you focus on behavior, that is not at your level of interest, you will be induced. Okay, so the first thing you need to do is mark levels. Then when it gets here, all right, when it's at this area, now you start looking at behavior. Up here, don't care, don't watch, don't trade, inducement traps. Don't watch is the key thing. If you watch this for an hour, 2 hours, 3 hours, you think you're disciplined, this, that, whatever, you're going to make errors, because all it needs to do is trigger FOMO after the third or fourth hour for you to get in. All right, so now when it's over here, now we start looking at behavior. Now start looking at behavior after reaching levels. All right, after reaching levels, now you start looking at behavior. There's no point looking at all here, here, here. Absolutely no point. And it is a major error to just watch the market all day looking at this level, looking at what it's doing and its behavior. You'll see this is a major, major error, because basically it's going to induce you to and then later on, why didn't I follow my rules? Why didn't I follow? Yeah, fuck the rules. Basically, you got to wait for market to go to your levels first, then start even spending any mental energy. All right, so that's the point. Up here, as the market rallies, and I'm just saying, in this case, you're what is it? Trend trading, buying pullbacks, right? So trend trading, buying pullbacks, market rallies. You don't care. You don't watch, you don't trade, because you know it's all inducement traps. And I'll show you exactly what the trap is. Like, there's a couple of traps. I'll show you what it is. So it goes like this. The first is it pulls back a little, and then it gives a little shitty breakout, fake out. Okay, as soon as it does this, people's FOMO goes crazy, and then it does this. So this is the first very well-known trap, which basically gets you in, then gets you out, right? So you're in, you call it in and out or whatever. In, out, right? The other trap, it goes up here, it goes here, it goes here, it goes here. You might think it's a spring, and then what it does, it goes here, then it goes here. This is in, and this is out. How is this an issue? It didn't pull back to a good level. In and out, stopped out. So it didn't pull back to a level. So these are just some basic traps. These are the consolidation traps. This one up here, you know, going in and out, this is always used, always. This one trap, this another one. I'll show you an example of this trap right here. Let's go to the ES. There's like so many, it's ridiculous. Oh, this is a good one here. It's so obvious, right? Over here you have gold, it goes down, gives a shallow, shitty pullback, right? Here, this is the minor upthrust, right? And the upthrust gets upthrusted. You see that? So this is your upthrust, and it gets upthrusted. And do you know why? This is your in, and that's your out. What the hell? This, okay, so market goes down, tap, 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 tap. This is in. Ah, this shit is so slow. Ooh. What the hell I'm doing? Ooh. What the? I don't know, this damn thing's stuck. Alright, great. I don't know what to do. So I don't know where we're at. Where was it? Alright, this is example. You're in here, you're out there. You're in here, you're out there. See this? You're in here again, because it goes below this low, and you're out here. Why? Because you weren't patient to wait for it to come back here. Let's see another example. This upthrust, let's say you took the in, it went down or here. You either got in on this early upthrust or got here on this early breakdown, and it takes you out. Why does it take you out? Because it didn't pull back enough. And this also has to do with stop location. So you have your innie, you have your outie, and then you have the screw job. This one is pretty clear because it goes back, right? Let's see this retracement. You see, if you're going to get in at 25% retracement, there's a problem. You see this? It's 25% retracement. It's a shit retracement. You're going to lose money. It just doesn't give you discounted prices. You see, and where did it give discounted prices? Near the 50, near this average, probably against this level and some bullshit level in here. Again here, see, it needs to retrace. Early in, early out, break. These shorts came in here and they went through a lot of pain. They may have gotten taken out above here if their stop was here. So anyway, long story short, there's a lot of traps, and you have to wait for markets to retrace. If you don't, they will get you in and then out, in and out, using the breakout or the breakdown to get you in, up thrust to get you out, etc., etc. All right, folks, I'm done. Take care. Have a good day.